health, financial, and home improvement. Enjoy being educated in such topics as personal injury law, community association law, family law, bankruptcy law, along with health show topics like pain management, men's health, and dental implants. Now, sit back and enjoy today's Ask the Experts with host Steve-O.
You know, I always open the show up with good afternoon, but God, today is horrible. It is. It's bad. But I guess it could be a lot worse if we were in Panama City or somewhere up north. I mean, they've really got it bad. Well, I got two really great shows for you today. And the first one is kind of a sore subject, tax relief. We have our tax relief expert on with us today, Attorney Michael Miller. He's an attorney now. It's not one of these places that they have these agents. What do they call the agents that are do the tax relief?
Tax mills?
Yeah, I mean, you see them on TV all the time. This is a local attorney, and I want to welcome him, and he's with us every month. Hi, Michael.
Hi, Steve. Thanks for having me again.
Boy, you just sound so different now from the first time we started. You're just like, today's show is really going to be good. You've got some things that I never knew existed. But let's start off by telling everybody about your practice.
Yeah, so I'm an attorney. And got an office in Palm Beach, as you mentioned. I'm a sole practitioner, so I'm by myself. So when you call me, I answer my own phones. I'm going to do all the work. I'm not going to outsource it to a paralegal or an assistant. I'm going to be doing the work. So, you know, a lot of people like that. And focus solely on tax resolution, IRS workouts, negotiations, usually collection matters that are already in collection, but could be other things. But just, you know, IRS work, getting out IRS jams and so forth.
Does it matter where anyone lives? Can they live in Dade?
Does not.
Broward?
We're dealing with federal tax law, so I need a power of attorney form to there's three types of people that can represent taxpayers in these kind of matters, and that's attorneys, CPAs, and enrolled agents. So I'm an attorney. I'm also a CPA. So there's no boundaries as far as state, jurisdiction.
Because we have a lot of people who are snowbirds, and now they're back home in New York.
Sure.
They still listen to the show. So you can handle their case also.
Absolutely.
The greatest thing that I think you do is you allow people to sleep finally again at night. Because once you take on a person's case, they don't have to talk to the IRS anymore.
That's true. They don't have to meet with them. They don't have to talk with them on the phone, and that alone gives, great relief.
It is. So let's just jump in. You've got a lot of stuff planned
so
for today,
three major themes for today's program. Okay, these are things we really haven't touched on in the previous programs. So one is just because you get a letter from the IRS saying you owe a certain amount of money, don't assume it's correct. You may not owe anything. You may owe a portion of that, but don't just assume it's correct. Give my office a call, and I think by the end of the program you'll understand why. Okay. Number two is the importance of always filing a tax return each year on time, even if you don't have the money to pay. So a lot of people
go ahead and file.
Yes, a lot, and I'll explain that in a second. Listeners will understand why. You should always file the tax return. And the third point is something that we covered on the previous programs, and that is that the IRS doesn't play fair. It's not a level playing field, and they really can't be trusted. They're not looking out for your best interest. So it's probably not a good thing to try to do it on your own. Call competent counsel, call my office, and let us handle it. And I think, again, by the end of the program, on all three of these points, you'll understand why.
Because they're not just bill collectors. I heard they are the toughest. Yet you
they're
do not
the most
want to
aggressive
get
bill collector there
yes.
is. And, after the program today, you'll understand some of the tricks how devious they are, and some of the things that they get away with that shouldn't be allowed by Congress. But right now it is allowed, and until Congress changes the laws, you got to deal with it. So first of all, let's talk about the importance of filing their returns every year.
Can we say if you're an IRS agent, can you please go to another station? Okay, go ahead.
Well, I'm going to say that if you're pro-IRS, and I don't think we're going to have a lot of people listening today that are,
right.
But if you are, you may want to turn it off and not listen, because it's not going to be pretty.
Right.
All right. So the importance of filing a return on time. So I have a lot of clients that come to me and they sit down and they say, I say, what's going on with your taxes? and they say, "Oh, Mr. Miller, I've been bad. I haven't filed in 5 years, or 7 years, or 10 years." And I just kind of cringe because it's not a good thing. So most of the time when people don't file, they do owe money. Not every time, but most of the time they do owe money, and that's obviously the reason they didn't file. But when you don't file for a year and you owe tax, you incur basically two penalties. You incur a failure to file penalty for not filing the return by the due date, and you incur a failure to pay penalty for not paying the tax in by April 15th. There is no extension for the tax payment. There is an extension for filing. But you've got those two penalties. But what people don't realize is that the failure to file penalty is 10 times greater than the failure to pay penalty. The failure to pay penalty is only 0.5% per month. It's applied against the amount you owe to figure your penalty. Okay? The failure to file penalty is 5% per month times the amount you owe. So it's 10 times greater. So by simply filing a return, let's say you owe $50,000 and you don't have a dime to pay. You don't have the money to stroke a check to the IRS. Simply by signing your return and doing an accurate return and putting it in the mail and filing it, you've eliminated 90% of the penalties that you will incur for that year. So if you learn nothing from today's program other than that, that's going to save you a lot of money.
Michael, why would someone who has a return not file?
Well, first of all, they don't understand the penalties. They believe that by filing, they're going to start a whole collection process. They may be moving around and don't think the IRS has their address, so they don't want to put their return on there. None of those are good reasons, because the ability to eliminate 90% of the penalties is going to save you a lot of money.
Oh, yeah.
And all you got to do is put it in the mail. You don't have to pay a dime. So that's kind of the first point. The second reason you want to file on time has to do with the statute of limitations. So the IRS has a 10-year statute of limitations on collection of the tax owed on a particular tax year. It starts when the taxes are assessed, which is generally 1 month or so after the return is filed. So if you file the return, you're going to start at 10 years. Okay? So I have people that come to me and say, "Mr. Miller, they're trying to collect a tax from 2005 or 6, and it's 2018. How is this possible? I read somewhere where there was a 10-year statute of limitations, and on paper it looks like it should have expired."
Right.
Well, I know exactly what's happened. They didn't file the return. 2005 was due April 15th of 2006. Had they filed it on time, it would have expired around May 15th of 2016. It would be gone. It would have dropped off, no matter how much they owed. But they didn't file it on time. They probably didn't file a bunch of returns. IRS caught up with them and said, "You need to file 5, 6, 7, 8, 9. They filed them all at once, maybe in 2010. That started the statute of limitations.
When the clock
and now
started.
it's going to run out in 2020.
Wow.
So that's why it's still there. Had they filed on time, this is another reason, it would be gone. And that's another reason when they file on time is to start the statute of limitations, okay? So there's a couple other reasons I'm going to jump on later in the program, but I want to jump to something else at this point. The next theme of the program has to do with the collection letters. So just because the IRS sends out millions of these collection letters.
Now, because you hear people, I got a call from them.
No, they never call.
I got an email from them.
That's a scam. So they always deal with letters, and then if they have to correspond with you, they deal faxes. They don't deal with emails. Okay. So you get a collection letter that says you owe $30,000 for 2016, for instance. My point is, don't assume that is correct. Okay? Give my office a call if you have doubts, and let's get to the bottom of it. Because, one of the things I do when a client comes in is I ask myself, does my client really owe this money? I don't assume and go out into collection mode and try to cut a deal. I first want to find out, do they really owe the money?
Okay.
Because I'm going to give a couple examples where bills could be sent out and the taxpayer or the client may not owe a dime. Okay.
Wow.
The first example would be, let's say you sold Apple stock for $100,000 and you bought it in 2000, sold it in 2017, and you bought it in 2015 for $120,000. So you've got a $20,000 loss. Under our system, no taxes owed.
Okay.
But you didn't file a tax return. You didn't listen to this program. You didn't file a tax return.
Right.
So when somebody doesn't file a tax return, the IRS does one for them. It might not be right away. It may be a year or two later, but they will do a return for the taxpayer. It's called a substitute for return, SFR. And what they do, they simply do the best job they can with the information they have. They don't have a lot. They have the W-2 showing them what was paid to you and what was withheld, and they have a 1099 showing them where somebody paid you. Could be gambling winnings from the casino, could be a brokerage, 1099-B for a brokerage transaction or whatever. So they have that information. So you take that and they do a return. But as you might expect, it's not a good return.
I wouldn't think so.
They don't have anything about your expenses.
Right.
They don't know how many dependents you have. And they don't know what your real estate taxes you paid, which your deductible are. And they don't know what your business expenses are, which you're entitled to deduct, all of which would lower your tax liability. They don't have any of that. But so they just do a return based on the income.
Easiest way possible.
Without any deductions. Whatever it spits out, they put that on the books, and then they start sending you letters. Okay, so an example I gave, this person sells $100,000 worth of Apple stock. He doesn't file a return. He or she doesn't file a return. The IRS waits a year. They don't get a return from this person. They know they got $100,000, so they do one for them. They give $100,000 proceeds. They don't know what the person paid for the stock because they didn't file a return. That's what you put on your return is when you bought it and what you paid for it. So they don't have that information, so they assume zero.
Right.
Zero paid, as if someone gave them the Apple stock that they sold. That's a problem.
They just do it
because
the
now you've got
easiest way.
Now you've got $100,000 gain instead of a $20,000 loss.
Right.
They also don't know when you purchased it in order to give you capital gain. If you held it more than a year, you'd get favorable capital gain rates, which would be 15% normally. They don't know when you bought it because you didn't file a return.
More than likely, it's going to be wrong.
So they assume that you flipped it pretty quickly. You didn't hold it a year, so you don't get capital gains. You don't get the 15%. You get the regular tax rates, which could be as high as 37%.
Wow.
So they do that. They send you a bill. So $100,000 gain, let's say a 30% rate, 30,000 tax. They tack on some penalties and interest. They send you a bill for $35,000. And in this case, you owe nothing. So that's one example of what can happen, why you shouldn't assume it. And one more example would be, I had somebody come into me and said, they called me and said, I owe $300,000 taxes. And I said, well, you must be self-employed. You just didn't pay anything in. They said, no,
Right.
I work for a major corporation, Palm Beach County, and I get taxes withheld every week for my check.
Wow.
So I knew right then they didn't owe the money, but I had to find out why. So they came in. I asked them a series of questions, things like, did you pull money out of a 401k, things that could have triggered this kind of tax.
Right.
They said no. And then after about 5 minutes, they said, oh, wait a minute. We sold a house in 2015. So I asked them how much. They said $500,000. So in this case, they filed a return, but they didn't put it on the return because they thought that it wouldn't be taxable. Normally it's not.
Oh.
Because the normal rule is you get to exclude, a single person gets to exclude up to $250,000 of gain on a personal residence.
Okay.
If you meet the test, live in it 2 out of 5 years. So that person thought, well, I'm not even going to put it on there. So the IRS gets his return. The computer checks and sees if he reported the $500,000 that came in on a 1099. They don't see it. So they calculate what the tax on that would be. They figure they don't know what he paid for the house. In this case, he had a $100,000 gain. But he's entitled to exclude $500,000, a married couple. So he's not taxed on any of that. He has zero tax owed.
And
but he just got a bill for
about
$300,000.
Wow. Now, why is it so high?
Because the IRS, just like in the other case, they don't know what he paid for the house.
Okay.
It's because he didn't file a return to give them that information. So they assume zero. So now he's got zero paid for the house. He sold it for $500,000. He's got a $500,000 gain. Okay?
Got you.
Then with penalties and interest or whatever, it ends up $300,000. And so in this case, we filed an amended return. We claimed the house. We proved that he lived in it 2 out of the 5 years. He qualified for the $500,000 exclusion. You exclude all the gain. There's no tax. That means all the penalties and the interest go away. So the whole thing goes away.
How long did that take you to figure that out?
Well, I had to get him in there, and I had to quiz him for a few minutes. But,
okay.
And, I got more gratification, I think, from sitting across the table from someone and telling him the good news that he doesn't owe the $300,000
no
than any fee he could have paid.
Think about all that sleep he lost.
So but I always ask that question: does my client really owe this? Because a lot of the national companies, I don't think they do that. They just jump right into an offer and compromise. And can you imagine if he would have just assumed he owed it and offered to pay them? Somebody offered to pay them $30,000 and thought they were getting a good deal, 10 cents on the dollar, and he just overpaid $30,000, or he got into an installment agreement and paid for 5 years. So
imagine all the sleep he lost thinking he owed that much
that's
money.
why you shouldn't assume that you owe it. give my office a call, and we'll get into it and see if there's a possibility that we can lower it, or maybe in these cases maybe don't owe any of it.
And don't you? They should not talk to the IRS themselves.
No,
I heard that's like one of the worst things you could.
Nobody really
do.
wants you to talk to the IRS either. So
yeah, that's true too.
So that's the second theme is don't assume you owe everything that the IRS just sends you. But
if they hire your firm, they don't have to talk to them at all.
They don't have to talk to them.
You do.
A lot of times the person gets a letter and it says, come down to the federal courthouse, the IRS building on so-and-so date and meet with us. So if they hire me and we get a power of attorney signed up, that meeting gets canceled. Because once I start dealing with the revenue officer, we're just dealing, by fax and so forth. So, that's a great, burden off the taxpayers.
Yeah.
So not to have to meet with them because you don't know what's going to happen. But
let's go to break.
Okay.
We're right at break time, and when we come back, we're here with Attorney Michael Miller. Give everybody your phone number, Michael.
Yeah, it's 561-313-5678.
And we'll be right back. Hi, I'm Steve-O with the Ask the Experts radio show. Join my co-host Renee and I every Friday as we interview some of the most prominent professionals in Palm Beach and Broward County. Each week we combine educational information on a variety of topics with a touch of humor and entertainment in the areas of legal, health, financial, and home improvement so you can be more informed. We offer interviews on such topics as family law, foreclosure defense, estate planning, sleep apnea, roof repair, funeral pre-needs, mold and mildew, alcoholism addiction, and even a show that teaches you how to buy a new and used car from one of the top dealerships in South Florida. If you have a business and would like to be part of the Ask the Expert show, contact us at 954-336-3767. Position your company as an expert in your field. Call Ask the Experts radio show at 954-336-3767. Be sure to catch our show every Friday from 4 to 5 p.m. or watch our show live at wwnnradio.com and click on the WWNN TV link. Hey, we are back. This is the Ask the Expert show. We've been doing this show for 4 years on the great 1470 AM, and we are also on 95.3 FM. I hope you're enjoying your ride home. We're talking about taking care, how to treat when you have a problem with your taxes. We are so lucky. We have such a great attorney. His name is Michael Miller. He's right down here. And this is just the things we're hearing today. This is about our fourth show, and I have never heard any of this.
It gets worse, Steve.
Oh, my gosh. Okay, let's continue.
So what we talked about before is the reason to file a return. I gave basically two reasons so far. Start the running of the statute of limitations and eliminate potentially 90% of the penalties that are going to apply by eliminating the failure to file penalty. Okay. But there's a third reason, and I just gave an example. All of that stuff about the IRS doing a return for you and all the bad things that come about, they send you a bill that you don't owe. Well, it gets worse than that. Not only do they send you a bill when they do a return for you, not only is the tax overstated, grossly overstated, and they send you a bill and it scares the heck out of the taxpayer, but they go one step further. They file a federal tax lien in the Palm Beach County courthouse and the public records of Palm Beach County saying the taxpayer owes, an example I gave, $300,000 when he sold the house. And they know that they did the return for him with limited information. It's not accurate, but they don't care. So another reason, the third reason you want to file your own return every year is so you avoid that kind of thing happening. You avoid having the IRS do a return for you, which is not an accurate return, a grossly overstated tax, and then a tax lien out there that's fictitious. And everybody sees it. Potential employers see it, lenders see it, and it makes you look like kind of a deadbeat taxpayer when you really might not owe anything. So that's the third reason why you want to file every year. And the fourth reason has to do with refunds. So if you have a refund, I said earlier that most people owe tax and that's why they don't file. But there are some people who have a refund and they might not want to file because they might owe for an earlier year. and they figure they're not going to see the refund anyway, so they might just say, to heck with it, I'm not going to file.
Right.
And I don't want to know where I'm living right now or something like that. So, but if you have a refund, let's say of $3,500 on your tax return because you're an employee and you have withholding and it's more than your tax. If you don't file that return within 3 years of the original due date, they will not pay you the refund. You lose it.
They keep it.
Yes. So if you have a 2012 return, it's due April 15th of 13. If you don't file your return by April 15th of 2016, you can't get the refund back. And not only will they not mail you a check for the $3,500 that they owe you, they will not even apply that $3,500 to other taxes you owe for other years. So let's say you had a prior liability in 2010 for $50,000, and you're paying in an installment agreement or something on that. That $3,500 that they owe you for 2013, they're not even going to apply it internally, do an internal accounting.
You've lost that.
It's one thing not to send you the check,
Right.
but it's totally another to not even apply it
Apply
against
it,
money
that's
they're
right.
trying to collect from you for other years. But right now, the Congress, I don't know why Congress allows them to do that, but they do.
Do you think they're going to
And it's
ever
just- it's-
overhaul the tax laws?
Well, they're constantly tinkering with them, but this kind of thing shouldn't be on the books.
Right, exactly.
Because it's not fair, okay? But it is, and now that you know it, you should file your tax return, okay, so that you can get that refund. Another example of how the IRS doesn't play fair. Remember I said earlier that when you don't file, the IRS will do a tax return for you?
Right.
Well, what do you think happens when you're an employee and you've had more taxes withheld than you owe? In other words, you're in a refund situation,
Right.
but you don't file. What do you think the IRS does in that case?
They're not going to give you your money back.
They don't file a return.
Oh, they don't file a return.
They only file the return. They only take the time to file the return when it helps them, when you owe them money. And then
But it's so easy the way
and then
they
they
do it,
prepare a
though.
return that's not accurate and send you a bill for a lot more than you really owe, and then you have to straighten it out. But when the tables are turned and they owe you money, and they know it because they have the W-2, they know how much was withheld, and they know how much you owed that year, and they know that they owe you money. But they don't do a return for you in that case.
That's an
And
easy return to do, isn't
That's
it?
not fair dealing. But that's how devious the IRS can be, and that's why you shouldn't try to deal with them on your own. Because, and these are just a few
That's
examples.
a very easy return to do it. All it's basically looking
And
at is how much you got.
And they should do it. It should go both ways.
Yes.
But when they
Wow.
owe you money, it's total silence, crickets. You don't hear from them, and they're hoping that you are asleep at the wheel.
Right.
You don't file the return within 3 years of the original due date, and they keep your money. And if you think about it logically, you've already let them use your money and play the float. They want you to pay taxes ahead of time in advance, so that's why they require it to be withheld from your wages. Okay, so they get to play the float anyway, and if you file 6 years later to get your money back, they've already had a windfall because they've earned interest on it for 6 years, but they want more. They want to keep the principal. They want to keep the tax
That
refund.
is horrible. You said
Okay.
it's going to happen today.
So those are just a couple of examples of how it's not a level playing field. And getting back to that, the tax lien, where they filed the fictitious tax lien, when they know that you don't have that much money, so everybody sees it and it hurts your credit and everything else. That's another reason. So these are all examples of how it's just not a level playing field, and
Well, one of the
Get
things I
good
want
counsel.
with the show is for them not to try to handle it themselves. Call your office, come in, talk to you, because you start talking to the IRS, you could give them a whole roadmap to your money.
You could, and that's not good. And you may say certain things, and the worst thing that happens is when they try to call the IRS sort of strong arms the taxpayer, and the IRS says, you're always entitled to an installment agreement. If you owe $50,000, you do not have to pay them $10,000 down. But a lot of times when taxpayers come to me, clients come to me and they tell me what's happened in the past, they'll give me a story similar to that where they talked to IRS on the phone and they said, you need to pay us $10,000 down and then we'll put you into some kind of installment agreement. So they're trying to squeeze some money out
Right.
of them. Well, you don't have to pay them the $10,000. You're entitled to get into an installment agreement and not pay anything down. But that's just an example of why, probably shouldn't do it on your own. You don't
Yeah.
know all the rules. And, kind
Like
of
you
some of
said,
the
you probably
examples.
don't owe as much as they say you do.
Yeah, and they're not gonna help you figure that out.
No.
But,
I mean, they're taking the easiest route possible when they're figuring it out for you. they know nothing about your
Well,
expenses.
they give you no deductions either.
Yeah.
But and their point is, you could have done it by filing a return.
Right.
So one of the points from today's program is they're right. You should file your return every year to avoid these kind of things from happening. But in the event that you didn't file your return, you should be very skeptical of a bill you get for a year when you know you didn't file, or maybe you did file, but like the example with the person with the house, you might not have filed a complete return. You might have left something off. So, you should give us a call and let us look at it.
Give everybody your phone
because
number.
like I said earlier, one of my first goals is to see, does my client really owe this money before I even get into how to resolve it?
Right.
And not everybody's going to do that, because if the tax goes away, there's no money to be made. But, like I said, I get a lot of satisfaction out of.
Now, how do you charge? You charge on an hourly rate?
No,
or?
I a fixed fee.
Fixed fee, okay.
Fee. So, and like an example with the person with the $300,000 liability, I did not charge them. I could have just said probably, look, I know how you can get out of this, but it's going to cost, some crazy fee,
Right.
a percentage of what I was going to save him. I just charged him how long it took me to do it, and that's it. So the number is 561-313-5678. Website is www.palmbeachcountytaxattorney.com.
And give the number out one more time, because we have people who are in their car driving
Yeah.
right now looking for a pen.
Yeah, 561-313-5678.
Listen, this is a great show. I can't wait for next month's show. I know you're helping people so much. Attorney Michael Miller, give him a call, and we're going to go to break right now. When we come back, we have our dental implant show. We'll be right back. Good show. Look how fast it was.
I know.
You are listening to the Ask the